Welcome to another episode of the Investing with IBD podcast. It's Justin Nielsen here, your host, and it is Wednesday, May 1st, 2024. We just had a Fed day, and we've got a lot to talk about. And joining me, as he always does, or almost always does, he wasn't here last week, but we'll forgive him that. And you're not going to be here next week, but we'll forgive that as well. Joining me most of the time is Arusha Paris. He's a portfolio manager and research analyst over at O'Neill Global Advisors. How you doing, Arusha?
Justin, I'm doing well, and I hope you enjoyed the fantastic roller coaster ride of today after the Fed talk.
Oh, see, when you said roller coaster ride, I thought you were talking about when I drove you home last night.
Oh, that's
which
right. Well, you didn't drive me home.
Yeah,
the car drove us home.
Arusha and I got to actually see each other in person, and with the full self-driving. He's got a Tesla, I've got a Tesla. We were in my Tesla, so we tried out the full self-driving for the entire ride, and I think it was 3 times that I chickened out, and
yeah, well, 99% of the time it did well until one time it came a little too close.
Yeah, that HOV lane with the wall on the left-hand side, I got a little, it was just taking the curve differently than I would. So,
yeah,
but yeah,
and so
we in person, man, that was awesome.
That was great, but if things went a little bit differently, they might have been looking for another two IBD people to hop on the podcast every week.
Yeah, we would have our special guest doing this solo, so let's go ahead and bring him on. Dan Fitzpatrick, of course, returning to the show. Great to have you. I mean, gosh, you're not that far away. We could have just, swung over and picked you up if we had thought about it. But Dan Fitzpatrick, of course, is the founder of StockMarketMentor.com. It's great to have you back, Dan. How you doing?
Hey, thanks. I'm doing okay. Now, this is true. While you guys were doing this intro, there was an earthquake here.
Oh, really?
Okay, I literally started. Did you feel that?
Oh, I didn't feel it.
I wasn't sure.
Usually,
because we've got some construction going on. The street's getting repaved outside, so I thought maybe it was a truck going by.
No, I think it's Earth.
Okay,
we got a big project going on here. The tectonic square down here is being formed. So I thought, what a great start for the IBD podcast, and the Earth moved.
Yeah, well,
we're not going to talk poorly about Tesla anymore. That's
no,
it's great. It's really good.
Like a boring machine underneath our house or something.
4.3.
Well, we will talk a little bit about the Fed, of course, because I mean there was a lot of movement with the Fed today. And plus we've got earnings, coming out. I mean, we were just talking before the show, Carvana up 40% in after hours. There had been just some crazy moves yesterday. Starbucks, down 10-12%. So a lot of movement in the earnings stuff. But gosh, let's just start with the market in general. What's your take right now? Do you want to start with the NASDAQ? We can pull a chart up and you can kind of give us your thoughts, Dan.
Yeah, such as they are. On the NASDAQ, it's the S&P. The charts almost look the same.
Yeah.
We've got this sell-off. We're in this weird place where the trend has obviously ended. And now there's just a question of whether that's kind of a shot across the bow. We're going to get kind of a slingshot move and come back to the upside. And it's like, whoo, okay, well, that was kind of scary, but we're still going to go. Or if that was kind of like the beginning of the end and the beginning of a new pullback. And I'm kind of in the camp for the latter case. Stocks have not been acting well even prior to this, but if you recall, I'm sure you guys were looking at the same exact thing that I was. On the 4th of April was when we got that little gap up. It wasn't that big a deal in the S&P or the NASDAQ. Right. And then everything just kind of snap hooked to the downside and had like the worst closing location imaginable, unless you drove it into the ground or something. And so since that time, it's just been kind of struggling. And so many things are down below the 50-day moving average. But yeah, you look at the NASDAQ. You look at the NASDAQ, and yeah, it's just got all kinds of pain on that chart. And so that's a real problem.
And as you suggested, it's not just about the market indexes themselves. You're also looking at a lot of the individual stocks and like hey, they're not looking the best right now. But how do you kind of determine, okay, is this just they've had these big moves, a lot of these stocks? I mean, they deserve to take a break,
Yeah.
a base. Is it just, hey, this is the pause that you would expect, a basing structure, time for some basing structures versus,
Yeah.
oh, this is the end of the trend completely.
Yeah. See, I think that at this point you really kind of have to conclude that it's just kind of a basing structure, because there's no justification to say, okay, this is the it. Now we're going to go into a bear market. I just don't think you can look ahead that far. And look, I think the Fed is all back ass words. I think they always have been. Um, I don't get me started on them. I mean, nothing against them personally,
I think
but
you got yourself started on it.
I did. Okay, can we go there?
Yeah, you can go there.
You want to talk a little
No.
bit, but
Okay. I was thinking about this earlier, like an analogy, because that's what I do. My mind is really kind of weird. Um, the Fed is like slalom water skiers. So the boat is the economy, and it's going to wiggle back and forth, but the boat's the economy, and the Fed is like extreme this way, and then whoom goes the other way, extreme that
Mhm.
way. And they go, and only for a split second are they right? And
Mhm.
then they just go on to varying degrees of wrong. And that's just because they rely on lagging data.
Yeah.
And then so it's like they rely on lagging data and the force. That's it. It's like, well, let's see, what's the force telling us? And you can hear that in Powell's um, speech, whatever you want to call it. Like he's using the wrong inflation data when he says, "Oh, well, it's under 3%." But he's not using the real number. He's just kind of picking his just kind of data picking, so to speak, so he can hit that. Like, well, we're on course. No, you're not. You're guessing.
Mhm.
Anyway, so the point for all that is, other than a gratuitous opportunity to bash the Fed, is that I think that the market gets kind of confused by all this, and confusion doesn't breed really, really massive selling. It just like
Yeah.
inhibits buying. Like, I think maybe, well, we were talking about this before the
yeah,
show.
yeah.
I don't want to have a lot of money in trades. Longer term, I'm kind of all in. But shorter term trading, I'm kind of confused. And so I want to wait. And Justin, that's because I don't know the answer to that question. Is
Mhm.
it just a garden variety pullback, like a healthy thing that we need? Or is this really the beginning of the end? Well, if you still got the NASDAQ up there, right? We'll put
Yeah.
it on a weekly chart. And this looks to me, um, that looks pretty good to me. That
Mhm.
Yeah.
weekly chart looks like it's just another in a series of higher lows. I could make a case for a cup and handle there, but Dave Ryan would probably be grimacing when I said that. But so far, I'm looking at it as just kind of a garden variety pullback, because it is a re-election year, and
Mhm.
I don't know what's going to happen with all that. I don't have a dog in that fight.
Yeah.
But
So Dan,
we'll leave Christy Nome out of it.
let's talk. Actually, get back more to that the choppy part, right? Because
Yeah.
I think, and we have all learned this the hard way. It's not necessarily the downtrending market that's the most dangerous market. It's
Right.
No.
this choppy, indecisive market, as you were talking about, where
Yeah.
Confusion.
one
Mhm.
exactly one day the stocks look good, the next day they take the money away, then they look
Yeah.
good again, and then they take the money, and so
Or
yeah, as we go.
forget one day. I mean, today it was 1 hour. They were looking so
Exactly, yeah.
strong, and then next hour, oh, not.
Yeah, I mean,
Yeah.
it was like it looked like we were gonna get a fall today,
Yeah.
right?
Yeah.
And then within that hour, we closed negative. So maybe talk a little bit more about that, because we were talking about that, as you
Yeah.
mentioned earlier,
Mhm.
how important it is to recognize this, because it's just gonna chop you. It's just gonna chop you to pieces. You're just gonna lose money very slowly, but
Yeah.
consistently. And
Mhm.
how you have to recognize that, hey, you know what? You want to have a little bit of touch in the market,
Yeah.
but you want to play with really, really small positions.
Yeah. I mean, it's tragic to say this, but the difference between the chopping around now when it's really, really hard and then the one where the market's just diving, where it's like it's so obvious that it's actually kind of easy.
Yeah.
You've been so busy losing all your money during the chopping period that by the time the downtrend gets really obvious, you're totally freaking broke. So you don't have any more money to lose. And so this is this is the time in the market where a trader really, really has to realize that, okay, it's been really great. It's been really pretty easy to make money since December, for the first few months. Like the first quarter, was pretty good. I was feeling like I was pretty smart. And that's always a tell that something's going to change. And then the market turns. And what inexperienced traders will tend to do is they'll want to continue to trade the same way because, well, this is how they made money. It's like the anti-definition of insanity, where you do the same thing again and again, and you expect the same results. And so you're going to keep doing that. But then when the market turns, it can take you, if you're not really looking at the market in a little bit more of a, I don't know, you'd call it nuanced way, but if you're not really catching what's going on, you're going to keep doing the same thing that you've been doing, only now you're getting different results and they're not good results. And so it just kind of takes you a while. It takes you a series of losses to finally say, wait a minute, something's not right here. And so the first rule of trading, or I should say of making money in the market, is don't lose your dough. Like, don't lose. And we're in the process right now where people are losing money. If they're still trying to, I'm going to buy Nvidia, or I'm going to buy, this is my time to buy MicroStrategy. No, it's not unless you're short and you're covering. People can really give back a lot of their money. And then what happens, guys, is so they make a lot of money on the upside, and then they give a lot of it back on the downside. And then when the market turns, as it always does, and it will, they waste the big part of that subsequent move in just making back the money that they lost, as opposed to growing their portfolio from that prior high. So I was up, I think about 45% in my trading account this year. And then I started giving it back. And I think now I'm up about 36%. And I'm basically out. I have a few things, but, and I'm okay with that. I can't top tick my account, but when I started giving it back and it went underneath 40, I was thinking, wait a minute, I've done this before and I was never happy about it. So anyway, so that's what I think. I think for the time being, the best thing to do, man, is not much at all. Pick your spots.
Well, and this is something that you said, a couple days ago to us. That's the channel your inner Tom Petty. The waiting is the hardest part, for a lot of people, but that's what you need to do sometimes is, sit on your hands. And I mean, if it means, don't look at your screen, do what you can to prevent yourself from over trading in an environment that just isn't conducive to it.
No, that's right. And the volatility, it's like moths to a flame, or dogs, like dogs are all calm. And then when a couple of them get together and start fighting, suddenly the whole pack's going like, wah, and you get in there and you have to look at this. And like I had said earlier, like high volatility, it's not really my game. So the waiting is the hardest part. And if you don't do that, you're going to be looking at the market saying like, stop dragging my wallet around here. So Tom Petty has lessons for us either way.
Yeah. Well, you know what, when we come back, we're going to talk a little bit about making these decisions, based on your individual stocks, why it's important to have standards, and also, having that quick, easy decision of stocks or cash. Stay tuned. We'll be right back. We're back for the Investing with IBD podcast. Justin Nielsen here, your host, along with Arusha Paris, who joins me most weeks. And of course, we've got Dan Fitzpatrick, from stockmarketmentor.com. He's joining us today, and we've been talking a little bit about the current market, and certainly one of the best things you can do, for a lot of your decision making is having those standards for your individual stocks. And certainly it seems like one of the things that happens sometimes is you get a little bit maybe overeager. You just want to do something and you kind of let those standards drop a little bit. But, can you talk a little bit about that, Dan? Why you think it's so important to kind of keep those standards high?
Yeah, the thing is, if you're trading correctly in a good market, you're going to be in the best stocks. I mean, that's how you make money. It's be in Nvidia and stocks with very, very high relative strength. That's what you want to be in. But when those start to break down, a lot of times what traders start to do is they start looking, oh, well, let me find the next winner.
Yeah.
And they start maybe not bottom picking or trying to really get the next huge winner, but they do lower their standards. So instead of like, well, let's see, not too many stocks above the 50-day moving average, which is kind of my litmus test for trades, certainly above the 200, or I don't even want to look at it. But okay, well, I don't see too many of those. So let me see about if I can find stuff in bases. And bases, by definition, go on for a long period of time. Otherwise, they're not bases. So why do you want to fart around with a base? Wait for a stock to start moving up. But what people do is when the really, really good stocks stop working, they do lower their standards. Like, what's the joke? A 2 at 10 and a 10 at 2.
Yeah.
For those of
the
you
barflies, right?
that go out on Friday and Saturday nights, you know what I'm talking about. But yeah, you just want to keep your standards to where they're the same. But the only way you can really do that consistently is if part of your trading plan is saying like you had mentioned earlier, I have cash, I have stock. This is what I have. The cash is all in dollars or Bitcoin, but let's just say it's all in dollars. The stock, well, there's any number of tickers there, but I have cash because the last 3 or 4 breakouts that I bought didn't work. So I got stopped out, or I got, I put the stock on the table and took my money. Okay. So I have all this cash. I need to exchange that for something that's going to be better, that's going to make me money. Now, I'm stating the obvious here, like duh, but a lot of people don't think about it that way. Like if you've got cash, now these days your money has lost money since the time that I started explaining this. I mean, let's face it, that owning cash is not king anymore, but it beats the hell out of owning a stock that's going down. So when you have cash, it's like that's dear. Like you want to hang on to that until you find the right opportunity, not any opportunity. And there's that old adage where if you're a hammer, everything looks like a nail. And that with charts, that can be a real difficult thing because charts are almost by definition, very, very ambiguous. Most of them are, which means most of the charts you look at are going to be basically worthless. It's like, let me go on to the next. There's nothing here, nothing here, nothing here. And then you're looking for those stocks that show really good, solid uptrends, nice little bases, little pullbacks, healthy things. That's how we make money if you're doing the IBD boogie, which we all are here. So those are very, very few and far between. But when you're not seeing any of those, yeah, you can lower your standards and start looking for something else. But another thing that you can do without really being aware of it is you start imagining things. You start like engaging in magical thinking, like, oh yeah, I think, oh, this is a good entry here. And then when it doesn't work out, 3 years later, when you get more experience, you look back at that chart and you go like, what the hell was I thinking? It didn't look like anything. And so you really, I mean, this is the way I would look at it too. You have to have standards before you're thinking about lowering them to find different trades. And so the first thing that I think a trader needs to do is like, what are your standards? I have mine. It's not perfect, but I have a moving average matrix, and 50 has to be above the 200. I have to see a proper setup. It's a real short list, very, very short list. But I have it. And so some of these stocks, and I have a lot of people on Stock Market Mentor, they're posting in the trading room every day, hey, such and such a stock is moving, or such and such. And a lot of them, if any of you guys are listening, I'm not talking about you specifically. Okay. Not talking about you. Okay. Somebody else. But a lot of those stocks that they're mentioning, I'm going like, what are you looking at there? And then I think, like, do you not watch any of my videos?
Right.
Yeah. Well, Dan, so it almost seems like, a lot of people will get, especially when you're newer to this, a lot of people will get into trading for that excitement, right? I remember the first time you got real-time quotes, and even Thinkorswim, and you saw the flashing lights. You get that adrenaline rush, right? You feel like you got to do something. When the bell rings initially, you want to make a trade immediately, right? But the longer you're in this, you realize that investing really shouldn't be exciting. In fact, it should be boring. Right. And because you talk about it, but maybe talk a little bit more about how it should be boring and just waiting for those fat pitches.
Okay. 2 memorable trades that come to mind. Back in 1997, stock splits were all the craze.
Oh, yeah.
Okay. So I was sitting in front of a Bloomberg terminal, and Cisco announced a stock split. I think it was 2 for 1. I called up my broker, because that was when you literally could call up your broker, and he'd go like, hey, Dan, yeah, you had to. Going like, buy me 10 calls on Cisco. I gave him the money, blah, 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 and all that. So I'm sitting there watching the stock go up. And by the way, this is when I had literally no money. So buying 10 calls was like huge. It was like buying a big piece of property now. I made $10,000 on that trade in about 45 minutes, and I started crying. I was so happy. I couldn't believe it. Then fast forward like 3 years, and I lost $172,000 on Emulex because I'd shorted puts on that. And I started crying there too, but it was for a different reason. So the bottom line though is, frankly, I didn't really know what I was doing. And the reason I didn't know what I was doing was because I didn't understand the nature of risk. And so it's only when you understand what your risk is, can you really start trading properly. And so you have to have a process. You have to have a process that works for you. And my process, like some of you guys on IBD Live, some of the trades that you're talking about, I'm looking at them and I'm saying like, okay, that looks like a good trade, but that wouldn't be my trade, because whatever the case may be. So that's the thing about people, that if you're starting to trade, you do need to understand that there is an art to it. You have to use your, I guess it's imagination. I don't know. I think if you trade long enough, you earn the right to have intuition, because intuition is your subconscious application of your experience. If you look at literally millions of charts and you're looking for just that right look, and I've heard Dave Ryan talk about that. It doesn't quite have that look. That's what you look for. And the 4-day course that I taught, there was an entire day that I dedicated to this. Okay, guys, all we're going to look at is charts that have that look. I didn't show them any crappy charts. And the idea is you got to burn what's right into your mind so deeply that then you just have this intuition that you're not going to get when you first start. The definition of intuition for an experienced trader versus a brand new trader is this: the experienced trader has a subconscious application of huge memory banks. The inexperienced trader, well, intuition's really just guessing.
Yeah. And you know what? A funny story to your point, Mike Webster, who, when he was a portfolio manager for Bill O'Neill, he came up with the idea one time to create kind of a model book of faulty bases. Like, oh, here are things that didn't work. Bill
Right.
said, go ahead and do it. I don't want to see it because I have
So
trained
smart,
my
yeah.
brain to look at all these charts that worked. I'm not interested. I'm not interested in looking at,
It's amazing,
a
yeah.
Right.
bunch of, I'm not interested in, having my brain kind of commit that to memory as much. I want to focus on the ones that work a lot more.
Did
So,
Mike ever do it? Did he keep going with it, or he just gave up on the project at that point?
yeah, I think he's like, you know what? That makes
Yeah,
sense.
because it makes sense, but initially it makes sense for Mike's point of
Yes,
view. Like,
yeah.
let me just study that stuff.
Mhm,
But
Yeah.
when I heard, what Bill said, it's
mhm,
like, yeah, you just want to focus on those perfection, right? You want to
right.
focus on that.
Mhm,
Yeah, I learned that's one of the things that I learned too. I learned it the hard way.
mhm,
But I really focus a lot these days on the psychology of trading because
mhm.
we can look at you can look at all the charts. And if you see the picture perfect one, like some of the miners like Mara and Riot last year,
Yep.
it's like
Yeah,
these
the Bitcoin
perfect
miners, right?
volatility squeezes and the one explosion to the upside. It's like, I need to get more money. And then you'll see NVIDIA, stuff like that. Okay,
Mhm,
that works. Those work really well, but those are so rare, so
mhm,
few and far between that the rest of the time you're just kind of rummaging around looking for the right charts, and you're not really seeing them.
mhm,
And so if you're not careful, like I tell people, if you sit at your desk long enough and look at enough charts, pretty soon you're going to find something stupid to do.
It's so true.
Um,
So
you
true.
know, yeah, like I tell people that you want to, part of your habit has to be pushing away,
Yep.
yeah,
Walk away.
yeah.
pushing away
Walk
from
away.
the desk.
Yep.
And I read a study not too long ago where the most profitable traders over time, like the most consistently profitable traders, spent less than 4 hours in the market every day.
Mhm,
And I think that's a good rule because I know I got really good when I first started trading a little more actively. Like I got really, really good at making money during the first part of the day, and even better at giving it all back during the middle part of the day.
Yeah.
You
Yep.
know,
Exactly.
mhm,
Well,
and
Nicholas Darvis, right? The how I made money $2 million in the stock market. He was
yeah,
getting charts that were like 3 days delayed and traveling the
mhm,
world as a ballroom dancer, right? So
mhm.
he did
yeah,
pretty well.
that's exactly right. And yeah, you don't need. I know people like the level two screens and all that stuff. Um, I never found those to be useful. I mean, these days I just look at I anything that's on my charts. It has to be it has to be worth something.
Yeah.
It has to give me information like moving average convergence divergence MACD.
Mhm.
I don't need that. That's a lagging indicator of two lagging indicators. Like
Mhm,
I mean, you could look at the price and go, well, hey, I think it's in an uptrend, and then I get a crossover. I mean, it doesn't work for me. And when I first started, I remember one of the first trading workshops I taught. I'm kind of embarrassed about it now, but I taught people how to have like RSI,
mhm,
stochastics, MACD, Bollinger Bands, Keltner channels. I might have even had Donchian channels in there, and the key moving averages. And it was like how to make art on a
mhm,
piece of paper with a bunch of different lines and squiggles.
mhm,
Now I use Bollinger Bands because they make sense to me. I worked for John Bollinger for a very short period of time back in, I think that was 2001, something like that. He's a really smart guy. So obviously, I'm going to kind of learn Bollinger Bands. And so I use that. I use the 50 and the 200-day moving average, and I use volume. And
mhm.
that's all. That's all
Keep
I
it
need
simple. Yep.
because all I want to do is buy low, sell high, or buy high, sell higher. I don't
Mhm.
need to see a stochastics pop or any of that crap. All that does is distract you, and it gives you a reason to do something that you shouldn't be doing,
Yeah.
you know?
Well, and I want you to kind of come back to a point that you brought up earlier because it's so important and something that a lot of people sometimes don't put enough time into thinking about, and that is risk management. You
No,
know, and sometimes that risk management is going to differ for different people.
yeah,
As you get older, your risk management style changes. When you're, in '97, $10,000. Hey, you know what? If you had lost it all, you had a lot of time to make that up.
Right.
So how do you kind of approach your risk management
Okay.
for things?
Yeah, I focus a lot on that now, more than I ever have, which is probably why I keep more money than I ever have. But the thing is, I'll start with, is this a good entry? It's, I got to find the right stock. But the way I look at it is this: I look at it in terms of R multiples, and that's
Mhm.
what multiple of the risk that I'm taking should I reasonably expect to be making. And so whatever price I buy at, then where is my stop? So that's the risk, that, and the number of shares. We won't talk about the dollar amount, but that's my risk. Like, let's say it's a $5 difference between where I buy the stock and where I put my stop. So I'll talk about that for a minute. So why do I have like a $5 stop there? It's not mathematics, it's not arithmetic, it's not a formula. It has to start with the entry. You have to have the entry such that if you're wrong, and you got a 50-50 chance of being wrong. Every time you buy a stock, could go this way, could go that way. You don't know that much. So you have to understand that. So where is the stock right to buy? And the way I would look at that is, okay, what level does the stock have to go down to before it hits the, oh crap, I'm wrong level, versus, oh, I'm just early. And so I need to be able to put a logical stop. In this case, it's $5, right? I need to be able to put that stop there. And then if I look at that as my risk, then if I can just make $5, that's not a very good trade, because I'm only making $5 for risking $5. Even if I make $10, that's a 2R multiple. I mean, that's better. And as long as you got a decent batting average, you can do really well on 2Rs. But I look for 3Rs. Like, I want to be able to look at a chart and say, if this stock does what I've seen so many other stocks do in charts that look just like this, if it does that, I'm going to have a really, really nice trade here. And so that's really what I look for, is the, like, if I'm right, where would the stock logically go? And then as that old saying goes, is the juice worth the squeeze? Is the reward worth the risk? And that's why I'm much more comfortable trading stocks where they have a lot of blue sky on top. Like, they don't have what I would call built-in sellers. So that's how I manage my risk. In fact, I just actually done, I think we got a couple more bugs in it. I've been working on this trade tracking tool for longer and many more dollars than I want to mention. But one of the things it has on it, you put in your trades, you actually calculate them before you do. Like, let's say I want to make this trade, put in your stuff, and right there on every single flipping page is the R multiple thing. So I look at that, and there have been several times when I'll put in a trade and I'll look at what the R multiple calculations are, and I'll go, no, it's
not
no,
worth it.
it's not going to do that. So it's not worth it. But you don't have to have an app to do that. You just have to use common sense. But that's how I look at it, is the probability and the likelihood of a stock moving up high enough, like maybe 3 times what you're risking. That's the way I look at it.
Well, maybe when we come back, we can take a look at some individual stocks to kind of see how you do some of these calculations and why you're keeping your standards so high. Stay tuned. We'll be right back. We're back for the Investing with IBD podcast. It's Justin Nielsen here, your host, along with Arusha Peiris from O'Neill Global Advisors. And of course, we also have as our special guest, Dan Fitzpatrick from stockmarketmentor.com. So Dan, let's talk a little bit about these individual stocks. And one of the things that you were, you kind of really drum home is, when you're wrong on a stock, you want to be wrong. You want to know you're wrong quickly, right? Why is that?
Yeah, well, the thing is, if you want to hold, there are a few things about this, which the second one I'll come back to in a sec, as far as how to look at this stuff to look at the actual market, like what's really going on, other than looking at the stupid S&P 500 chart. But the idea is, if you want to make a lot of money in a stock, you need to hold it for a long period of time. And by the way, that impatience is what keeps people from really making money on stocks that work really well. Like, how many times have you looked at a stock that's really, really screaming and you go, oh yeah, I bought that last year. I made money. I made 8%. Meanwhile, it's up like 390%.
Right.
And you totally missed that trade. So you can get impatient with your winners. I need to book that profit. But what you really need to be doing is getting impatient with your losers. Because the idea is, if you're tracking your trades, separating them from, like, here are my winning trades, here are my losing trades. Forget about how much you made or lost. How long did you keep the trade? Because you should be eager to take a loss. If you're buying the stock right now and then it moves against you, okay, you give it a little bit of wiggle room. But if it starts moving down a lot, you have to say, well, wait a minute. If I had known it was going to do this, would I have bought the stock? And unless you're really, really stubborn and arrogant, your answer would be, well, no, I wouldn't, So then you need to get out of that. You need to exchange the stock for cash. Now, you could look at the stock and say, okay, you know what? I do want to buy it. So you're just buying it at a different time. You were shaken out, so to speak. And that's part of trading. But you want to be holding your losers for a very short period of time. It's like going out on a date and it's a bad date and there's no really spark of love there between you and the other person. You're not going to ask them out again. You're just going to move on to the next thing. So it's a little bit like speed dating. But if it moves against you, then get out right away. And so if you look at your trades in that way, your losers should be held very, very short period of time. And then your winners, this is the way I look at it. Hey man, if you got a position in a stock that's really working, why do you want to do anything else? Like, you want to sell something that's really working and find something else that's maybe going to work. Like, that's
Not
just
50-50.
That's not good logic. And so,
and there's that saying, Dan, right, where it's like, sometimes the best trade to make is the one that you already have, right?
Yeah, absolutely. I mean, sometimes the best trade to make is to shut off your trading platform and go get a cup of coffee, or something, or just say, like, I'm good. And I do feel that if people would honor their stops, and I mean, what's your average trading frequency? If you're a day trader, look, you're a junkie, you're right there all the time. How much money can I make now? Oh, now it's the time where I give it back. Okay, let's do a bunch of stupid stuff so I could give it all back. Like, if you want to be that guy, go for it. But if you're really trading well, you look at the market in the morning, you look at how your positions are doing, you look at any other candidates that you've spotted, and then you make decisions. And your decisions are different than your actions. That's the way I look at it. Is, if I'll say, like, I want to, for example, I like Spotify. And I'm not talking specifically about that stock, but here's the deal. I've made a decision. I want to buy Spotify, but I may not buy it tomorrow. I want to buy Spotify, but now I need to look and see, will I get the setup that warrants me actually exchanging the cash for the stock? And I don't know whether that's going to happen or not. But if the stock continues to set up well, then that's something I'm going to want to, get into. I mean, the fundamentals are good. It's always nice when a company starts making money instead of bleeding. And that's what's happening there. So, I don't need to go into that too much. But
so, Dan, let's actually go into a quick example of a trade where you would be out very quickly, right? You have that low day. So I pulled up HubSpot here because we were actually talking about HubSpot on Monday as a potential stock that we
Yeah.
could show on the podcast, but now, that kind of got cut. So
Way
maybe
back
talk a
then,
little
2 days ago, it was holding the
Exactly,
50-day
yeah.
moving average line and, all of that stuff, right?
Yeah, I know. Like, if you just look back a couple bars there where it was holding right there at the 50-day moving average after it's a nice breakout from a volatility squeeze, pops up to 693.85, pulls back really nicely, nestles in there to the 50-day moving average. And I'm going like, oh my gosh, I'm getting the warm and fuzzies here. This looks so awesome. I love HubSpot. I have no damn idea what they do, but I really, really like the chart. I don't know. Maybe they make hubcaps. But so I want to buy that. And then 2 days later, it's like, no, not a chance. So here's the point, back to your question though. So let's say I bought it on Monday. Yesterday, I would have been out
Mhm.
just because the stock does exactly the opposite of what I thought it was going to do. So I was just wrong on that. And it's okay to be wrong. It's just not okay to not be willing to admit that you're wrong.
Right.
That's where people have a tough time, because one trader like I would look at that and I'd buy it on Monday, and then on Tuesday when it goes down, I'd go, okay, crap, this isn't working. Then I'd keep it on a watch list, but it's like, no, I don't want to have my money in that. I think it's going lower. Whereas somebody else might look at that on Monday and then they see the big move down on Tuesday and they don't sell because they don't want to take a loss. And look, maybe, and it happens in a market like this where so many stocks are breaking out and aren't working. Maybe they've taken a loss on the last 2 or 3 or 4 trades, so they don't want to take a loss again. And so they're holding the stock. It keeps going down, and they're not recognizing the fact that the entire thesis for buying that stock is totally negated. They shouldn't be in that stock. Instead, they're looking for a new reason to stay in the stock so they don't have to lose money. And I tell people all the time, hey, you can always buy it back.
Yep.
You can always buy it back. And most of the time, though, you don't buy it back.
Right.
That's the thing. When the stock does what you don't think it's going to do, it's very, very rare that a day or two later you're going to say, oh yeah, no, I do want to buy that stock, and then have it work. Most of the time you're going to say like, well, thank God for yesterday. So,
And it's funny, to your point, like, you can really get in that mindset of, okay, I've had a loss. Okay, I don't want to do another one, because now I'm losing too much money. Or even worse, some of those losses that you took, you could see bounce backs, and you're like, oh, if I hadn't taken that loss, I would have been okay. And then you start getting into the mindset, well, I'm not going to be fooled this time. And then that's the one that just implodes, and you're like,
yeah, you can get upside down really easily, and in a real violent and nasty way. You can get upside down where you buy a stock because you think it's going to do one thing, and then it doesn't, and it goes down, and you don't sell it, and finally you go like, I got to sell this stock. So you sell the stock. Of course, you held it to a point where now it rebounds up, because stocks go up and down. And then you're looking at it and you go like, crap, I need to buy it. I got to buy that stock back. Oh, I know. I need to wait till tomorrow to see if it goes up again. So I know then I can buy it back. And then you buy it back, or you don't buy it back the next day because you're going, okay, well, maybe now it's too late to buy. So I'll wait until tomorrow. And then if it goes up, then I'm going to buy the stock. And so then you're like, you've bought and then you've sold low, and then you watch the stock go all the way back up, and now you buy high, and the same thing happens over and over again. And it's like, if there was an alien, the kind from outer space, if there was an alien that came down and was looking over your shoulder, they didn't know anything about trading at all. They're looking over your shoulder to see what you were doing. Here's what I would say. You want the alien to understand what you're doing just by looking at what you're doing. But a rational alien looking over the shoulder of a crappy trader would be going like, oh, I see. They're trying to give away all their money. You know,
Let's destroy this planet. They're stupid. No.
yeah.
Well, let's go ahead
Or
and move on.
they're stupid. They're stupid and funny. So let's just keep it and let's watch them.
So let's go to another stock here. Novo Nordisk was another one that you brought up. Now, this one did have a little bit of time below the 50-day moving average line, but it came back up. And why was this one? Why is this one not looking as bad to you as HubSpot?
Well, it's not looking as bad to me because it is. Well, this HubSpot was looking pretty good a couple days ago,
Right.
but it was kind of that. It was pretty choppy. HubSpot was pretty choppy. If you look at Novo, it hasn't been choppy. It's been in a nice move after this volatility squeeze and pop in January. But then since they ran up on the 3rd of, on the 7th of March, you know, that big thing at 138.28, it's been an orderly pullback. And yeah, it's spent quite a few days actually below the 50-day moving average, but not, I mean, I look at it and it's kind of in a constructive way.
Yeah.
And if you drew an anchor, I don't think you guys can do that here, but if you drew an anchored VWAP on the chart from that high, you would see that the stock thrust above that just yesterday a little bit, and then today it's up above it, and so that, you know, that tells me that generally speaking the stock can run higher. So I like it in that vein. But the one thing that I don't like about it is they report earnings tomorrow.
Right.
Yeah, and I should say I do own a small position in it, and
You
I'll
gonna
keep
keep
my
it?
finger.
I do have a position as well. I've got a little bit like a 20% profit on it, so I'm okay. I'm okay keeping it. So I'm keeping it for my Danish brethren. You know.
There you go. You know what?
Always
You know
have
what?
to
I have true confessions. I have an admission. I've actually done not Ozempic, but one of the others. Ozempic, you know, I tried to, because I've lost about 30 pounds over the last 5 or 6 months or so.
Okay.
And first I tried Ozempic and I ate my way right through that. You know?
I'll show you.
I'm gonna buck the trend here, baby. I'm gaining weight. Then I went on another one. I'm just talking about this whole thing about the obesity drug thing. And it's totally working for me. I'm on a kind of a maintenance dose now. You know, I don't want to look like I just got out of a prison camp. But the thing is, this stuff does work, and it works really well. What the prognosis is, it just depends on if people are using it to adopt good eating habits or if they're just doing it for a magical elixir. But I think that this drug, not only Novo Nordisk, but Eli Lilly too. I kind of think this stuff's just getting started.
Yeah, and I do own a position in Eli Lilly too.
Yeah,
same thing, Dan. It's just like there are two kind of big trends in my opinion that are happening right now. AI, which we've talked about left and right, we all know about that, and then this weight loss drug, and it's just slowly kind of starting to spread. And congrats, Dan. I mean that's pretty incredible, right? 30 pounds. And you're not the only one, right, who's experiencing this. So there is definitely, seems like there's something there, and it could keep growing.
Well, think about it this way too, because you know, no, I was actually talking about this to my members in an earlier video. I think it was about Starbucks. How all it takes is a little shift in people's habits. You know, not you, not me, but just in general. All it takes is a little shift, and it can either destroy or absolutely make your business when the crowd kind of shifts attention. You know, that happened with Starbucks the wrong way. That's what I think anyway.
Or
I just
Blockbuster. Blockbuster.
Yeah, well, Blockbuster, yeah. But so the thing is, you know, you think about this. Oh, they've gone up too much. Well, how many friends do you have that have lost a lot of weight? They look better, and you can say, oh, it's a horrible drug. You know, oh, it has these side effects. Yeah. One of the side effects is you lose a bunch of fat. But the point is, we all know somebody who's done really well on that, and they look good. Okay. Well, how many people are going to see those people and go, well, you know, me too. So I think we're getting a good me too dynamic rather than the bad one that, from years gone by. And also, guys, it's May, summertime's coming up. Everybody wants to look good in a swimsuit. Few do, but most want to. So,
and imagine if they once they eventually come out with the pill form,
right?
Yeah, which
very different.
Even easier. You lower the barriers even more.
Yeah, and so I think you still got to trade the chart.
Yes,
you
absolutely.
have to trade the chart. But to say, let me put it this way: I saw, I forget his first name, Wang, the CEO of NVIDIA.
Jensen.
Jensen. Yeah, I saw him speak at a convention in San Francisco back when it was really San Francisco, and this whole GPU thing was awesome. I'm going like, oh my God, I got to buy some NVIDIA. And I think I did. And I made about 8% on it. And then that was the end of that. And you could have looked at NVIDIA like 10 years ago and gone like, okay, well, it's too late. It's already gone up a lot, but it wasn't too late. And so I'm saying, I'm not sitting here going rah, 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 obesity drugs, like they're the be all end all, like these stocks are going to go up forever. But I think what investors need to think about, it's part of the CanSlim thing. Like, what's the industry that they're in? Is this an old industry or is it a new industry? And this is a pretty new industry. And then you just look for the leaders. It's all pretty logical stuff. And then as far as like, oh, well, they've gone up too much, trade the stocks. Just let the stock tell you if it's gone up too much or not. Pick your entries. And I'm just looking at, I can look at the Novo chart and see a bunch of different entries there. You buy now, put your stop at 121.75. You're good. You
or maybe wait till after earnings.
Well, yeah. Wait, don't anybody do that.
No, everyone's going to be hearing this after.
Oh, that's true. That's true. Yeah. Earnings.
Or is it in the I'm not sure if it's in the morning or after the close.
Okay, well, let me do that. Hopefully they'll hear. Hopefully this will be afterwards. So I'm gonna do this, guys. So I really like Novo Nordisk. I think they're gonna blow earnings away and they're gonna scream. You got to buy it right now. Okay, now if that happens, then let's go with this.
So we'll cut.
We can edit this.
Do the other one.
Don't edit it in post.
Okay. Yeah, I want to go both ways, if possible.
Well, you know what? Let's wrap up with just a quick overview, because financials definitely have been getting a lot of attention. And Goldman Sachs was one that you were recently chatting about with an old friend of yours.
Yeah, with Cramer. Whenever Jim Cramer asks me to do anything for his show, I will always do it. If I die, then I'm not going to be able to. But other than that, I'll always do it for Jim, because if Jim was the guy that invited me to write for thestreet.com, age, I don't know, 20 years ago, more than 20 years ago. And if it wasn't for him, I got that exposure, and then I went on to, do what I'm doing now. And so I feel like I owe him huge. So he asked me the other day, the subject line on his email was help with an exclamation point. It's true. And he wanted to know, like, dude, do you have any stocks? And I know what kind of stocks Jim likes: banks, Goldman, right away. And so if you look at that on a weekly chart, you'll see a pretty nice, that's a pretty nice base for a long period of time. And you even look at the earnings bar, the earnings line starting to come up. And so I really think Goldman Sachs has a ways to go. I think it can go a lot higher than it is. And the daily chart, it's kind of a little jiggy, it's a little sloppy, but I think buying it here is not a bad idea. If I was just trading the stock, I'd probably wait for it to come in a little bit because you could see the zigzag. But if you're saying like, oh yeah, I think Goldman could be a 500 or a 550 stock over the next year, well, take a small position now, and then if it pulls back, get the rest. But plan your trade first. So yeah, I like Goldman. By the way, Justin, one thing in Arusha that we were talking about, I don't think I got a chance to mention, is your individual trades. I think you got to focus on breakouts all the time, even if you're not buying them. When breakouts are working, that's the sign of a strong market. Earlier, over the past several months, breakouts have been working really well. But when the breakouts stop working, you don't even have to look at the S&P or the NASDAQ to know that this is a weak market. So the individual stocks can tell you a lot. And like, I think that the economy is actually really weak for a lot of different reasons. But you know what my latest one is? Starbucks. Starbucks is the ultimate strong economy. Give me the double, triple latte with the 1/2 vanilla shot and the chocolate sprinkles and the extra soy milk really hot with with another teaspoon of foam and all that, But if people aren't doing it, if people aren't frequenting Starbucks as much, even if they're doing it 4 days a week instead of 5, you're going to see a chart like that.
Yeah.
So you could get a big picture from little pictures in a lot of different stocks. And I think that you ignore that at your financial peril if all you're doing is just looking at the S&P. You got to be looking beneath the hood. And it's really not that hard. It's if you have a few different things like the thing that I just pointed out, it's really not that hard to get a better take on the market. There's a lot of times that I don't, not deliberately, but I don't look at the S&P. I don't look at any of the indexes. And the reason is just because right now I'm seeing other things that are more important to me. And I don't even think to look at what's the S&P doing because I'm not an S&P trader. I just look at individual stocks. But if they're not working, if breakouts aren't working, you shouldn't be working.
Yeah. Well, hey, Dan, it's always a pleasure having you come on and chat with us. And again, for folks that want to learn a little bit more about Dan's approach and everything, go to stockmarketmentor.com. Anything else that they should know about, what you offer there?
Yeah, with that, I do videos every day. It's trading videos to give, and I keep an active trade idea list. So I'm giving people, it's kind of like I'm teaching people to fish and I'm also putting some on the hooks. And so I got people that are there for 15 years. I don't know why. I mean, some of them are such longtime members that they actually die as members. So anyway, you could be one of those guys, not the ones that die, but just the ones that stick around for a while. So
very good. Well, definitely something worth checking out. And of course, for those of you that are enjoying this podcast, please make sure that you go to investors.com/podcast, go to Apple, Spotify, wherever you get your podcast, like and subscribe. And hopefully you enjoy the content that we bring you. Thanks a lot, Dan, again, for being with us.
Hey, Justin, Arusha, thanks, guys. It's always a pleasure. I'll see you in Vegas later this year.
Okay, that sounds like a plan.
Okay.
That's going to wrap it up for us this week. Do join us next week. We're going to have Jeremy Owens. He's just started a new podcast. He is one of the Market Watch tech editors. So it's going to be great to have him on the show. I met him a couple years ago out in New York. So we're going to catch up with him and see how his podcast is doing and really dive deep into the tech. So hope you join us for that. Thanks a lot for watching this week. We'll see you next time.